The biggest threat to the U.S. economy may not be AI, China, or politics. It may be something most people have never thought about.
The answer may begin in Tokyo, specifically in Japan's government bond market, a market most Americans have never heard of.
To understand why, we go back to the early 1990s when Japan had one of the biggest asset bubbles in history, and it burst.
Real estate collapsed, the stock market crashed, and Japan entered what became known as the lost decades, nearly 30 years of stagnation. Japan's central bank responded the same way all central banks do in a crisis. It cut interest rates, first to zero, then below zero.
When even zero rates weren't enough, Japan introduced yield curve control, actively preventing long-term bond yields from rising at all. The result? Japanese government bonds offered almost no return for decades. If you invested in them, you earned almost nothing. This created a major problem for Japanese investors. Banks, pension funds, insurance companies, they needed returns. Japan couldn't give them any. So they looked elsewhere, and they found something very attractive. U.S. Treasury bonds, paying several percentage points more than Japanese bonds. This is how Japan became one of the largest buyers of U.S. Treasury bonds in the world and one of the largest creditor nations on Earth. But investors went even further. They discovered something called the yen carry trade, and it changed global finance for 30 years. The idea was simple. Borrow money in Japan at near zero interest rates, convert it to U.S. dollars, then invest in higher-yielding assets. U.S. Treasuries, technology stocks, real estate, emerging markets, as long as Japan's rates stayed near zero, the profits kept flowing. The entire system rested on one critical assumption, that Japanese interest rates would remain low forever. Over the years, trillions of dollars flowed from Japan into global financial markets. The U.S. benefited enormously from this cheap capital. Then in 2024, that assumption shattered. The Bank of Japan raised interest rates for the first time in 17 years. Financial markets reacted immediately. After the second rate hike, Japan's Nikkei index dropped more than 12% in a single day, its worst fall since 1987. And the S&P 500 fell roughly 6%. The American market shook because something had changed in Tokyo. When Japanese rates rise, borrowing yen gets more expensive. The carry trade becomes less attractive. Capital that left Japan for decades starts returning home. This process is called capital repatriation, and for U.S. financial markets, it matters enormously. Here's why. Japan wasn't just another bond buyer. It was one of the largest and most consistent buyers of U.S. Treasury securities for 3 decades. Long-term Treasury yields aren't controlled by the Federal Reserve. They're set by supply and demand, and Japan was a massive source of demand. When a buyer this large steps back, Treasury yields must rise to attract new investors. Higher yields mean higher borrowing costs for everyone. This creates a strange situation. The Federal Reserve can cut short-term rates, yet long-term yields stay high. That's not a contradiction, it's Japan. And long-term rates touch everything. Mortgage rates, stock valuations, corporate borrowing costs, all priced off the long end of the treasury market. In other words, for 30 years, cheap Japanese capital quietly kept U.S. interest rates lower than they would otherwise have been. Now that invisible hand is lifting, and the U.S. government is running multi-trillion-dollar deficits, issuing enormous amounts of new treasury debt every single year. More supply, less demand. That combination pushes Treasury yields higher and ripples into mortgage rates, stock markets, and economic growth. The bond market is often called the backbone of global finance because sometimes the biggest risks aren't the ones dominating headlines.
And if this finally made sense, hit subscribe. I break down economics like this every single week. See you next time.